You believe success in speculation is about constant motion. That is the first lie you must burn from your mind. That need to always be in the market is not ambition. It is an addiction to noise. It is the guaranteed path to the clearinghouse. The primary work is not execution, it is observation. The real money is made in the waiting, not the trading. It is made in the undeniable setup. You are losing capital because you are confusing motion with professional action. You have mistaken the constant noise for opportunity. The primary work is not execution, it is observation. The real money is made in the waiting, not the trading. It is made in the undeniable setup. The market pays the man who waits. It does not pay the man who is constantly active. My greatest gains have always come from absolute grinding patience. They came from weeks of sitting idle, waiting for the one perfect moment to engage. You must stop confusing motion with opportunity. Opportunity announces itself clearly, and it rarely appears more than a few times a year. Your job is to preserve your capital until that signal is delivered. Until then, you are merely a spectator, refining your view and preserving your ammunition. This is not passive. This is the highest form of discipline. The market is not a daily job. It is a serious, calculated endeavor. It is a long game played with short, decisive movements. The fool seeks profit in the noise. The professional seeks certainty in the silence. Forget what you think you know. Forget your convictions. Forget every single analyst and all the chatter that clogs your screen. The market does not care for your opinion. It cares only for the truth of price action. The price is the ultimate truth teller. If the price moves against you, you are wrong, full stop. Your greatest enemy is not the professional on the other side of the trade. Your greatest enemy is the hope that whispers in your ear. It tells you to hold on just a little longer, that the stock is due to reverse. Hope is the emotion that transforms a small, manageable loss into a catastrophe. I have never made money holding on to a losing position because of a feeling. The market is never wrong. Your hopeful opinion is always wrong when the price action contradicts it. Learn to read the action, not your wishes. The moment emotion enters your execution, you have already failed. Fear, hope, and greed are not states of mind. They are execution risks. They corrupt the signal and destroy discipline. Your trading must be mechanical. It must be an operation performed by a surgeon, not a gambler. When you feel the panic of fear, you sell too early. When you are overcome by hope, you hold your losses too long. When greed takes hold, you over-leverage or you fail to take the profit the market is giving you. These are not flaws in your system, they are flaws in your character under pressure. Successful speculation demands a motionless operation. You must follow the rule, not the feeling. You must be a machine of discipline, not a creature of impulse. The professional separates the mind from the money. Do not enter a trade until the path of least resistance is not only visible but undeniable. Speculation is not about guessing which way the market might go. It is about waiting for the market to tell you which way it is going. The prevailing trend is your only guide. Attempting to pick tops or bottoms is the sport of novices and the shortest path to financial destruction. You must wait for the sustained, clear movement that confirms the market's true direction. The force of the primary trend is a river. You must position your boat in the current and let the power of the market carry you. If you fight the current, you will exhaust your capital and drown. Wait for the market to establish the line of least resistance. Then, and only then, step in and commit your capital. Your patience determines your power in the market. The minor fluctuations are distractions. They are noise designed to tempt the weak and confuse the uncertain. Your focus must be unwavering on the major trend. That is where the real money is made. The main movement is always followed by a reaction, but that reaction is merely a brief pause. These temporary setbacks serve a clear purpose. They shake out the timid traders who lack conviction. They allow the professionals to consolidate their positions and prepare for the next surge in the main direction. Never confuse a minor correction with a major reversal. If you are correctly aligned with the primary trend, ignore the noise. The major trend is your friend. The minor reaction is your test. There is only one true entry signal, the pivotal point. The market is not random. It moves in calculated stages. It consolidates, it tests, and then it confirms. The pivotal point is the price level that defines the end of the testing and the beginning of the movement. You must wait for the price to break free of its prior range and confirm its new direction. Entering before the pivot is crossed is a guess. Entering after the pivot is a commitment based on evidence. I have learned to trade only when the price action definitively breaks out of a clear pattern of consolidation or reversal. The pivotal point is the line in the sand. When the price crosses it with conviction, the signal is given. Do not concern yourself with getting the absolute lowest or highest price. Your concern is precision and confirmation. The move is always more important than the price. The amateur's greatest folly is averaging a loss. You have made a mistake. The market is telling you so by moving against your position. Your response is to commit more capital to the losing side, compounding the error. This is not strategy. This is financial suicide disguised as commitment. You are throwing good money after bad, betting your account against the market's superior judgment. This disastrous practice ensures that when the market finally moves decisively against you, your full force is arrayed on the wrong side. The first loss is always the cheapest loss you will ever take. Cut it immediately and cleanly. I have made my worst mistakes not by taking losses, but by allowing a small loss to grow into a major one because of my own foolish pride. Never reinforce failure. Accept the verdict of the market and preserve your capital for the next, better opportunity. You must know your exit before you know your entry. The precise point where you will admit defeat must be defined and hard-coded into your plan before a single dollar is committed. This is non-negotiable. This defined exit is not a prediction. It is your maximum risk. It is the mandatory insurance premium you pay to operate in the markets. If the price hits that point, you execute the trade and exit the position immediately, without argument or second thought. Any hesitation here is a fatal lapse in discipline. Your emotional self will tell you to wait. Your professional self must override that voice. The stop loss is not a suggestion. It is a declaration of capital preservation. You must treat it as sacred. Never move your stop loss further away from the entry to accommodate a poor trade. If your initial conviction was correct, the market will not test your limit. Price action cannot be read in isolation. It is only half the picture. The conviction of the move is held entirely within the volume. Volume is the fuel. It is the measure of the market's commitment to the new price level. A powerful price breakout on low volume is almost always a trap. It is a lie perpetrated by speculators seeking to catch the unwary. When the price confirms a pivot point, you must see the volume surge simultaneously. High volume is the truth. It is the undeniable evidence that institutions and large money are supporting the move. A high volume confirmation tells you that the path of least resistance has been permanently established. If you do not see the fuel, do not commit the capital. Always demand volume confirmation of significant price movement. Trade the confirmation, not the price alone. The market has a way of confirming your decisions immediately after you make them. A stock must act right after you initiate your position. If you are correct, the price should confirm your entry and begin to advance almost immediately, or at least hold its ground firmly. If it hesitates, if it stalls, or if it reverses quickly back toward your entry price, you must exit. This is a sign of underlying weakness. It signals that the expected follow-through from the large interests is not materializing. Do not wait for your stop loss to be hit if the trade is clearly showing poor behavior. A trade that is acting wrong is a trade that has failed. Get out quickly and preserve your mental and financial capital. The cost of a small, quick exit is negligible compared to the cost of nursing a bad trade back to health. The strategy of pyramiding is not a means to recover losses. It is a means to multiply profit. You must only add to a position that is already showing you a clear, undeniable profit. This is the only way to utilize the market's own power to fund your expanding position. But you must be systematic and cautious in your additions. Always scale down the size of subsequent additions. Your initial commitment, the one made on the pivot point, should be your largest. The second addition should be smaller, and the third smaller still. This ensures that even if the trend reverses suddenly, your largest commitment was at the lowest price, and your overall average is protected. Never, under any circumstances, add to a marginal or losing trade. That is the behavior of the gambler, not the speculator. Add only to strength. The hardest lesson for the emotional trader is the value of inaction. You must recognize that there are specific market conditions that demand complete and total cash reserves. These are periods of uncertainty, extreme volatility without clear trend, or simple market exhaustion. When opportunity is absent, sitting idle is in itself a profitable position. Your capital is your army. You do not send your army into battle when the intelligence is conflicting or when the terrain is unfavorable. You hold your reserves until the conditions for a clear victory are present. The money you save by not trading during unfavorable times is profit preserved. The mental capital you save by avoiding unnecessary losses is priceless. Be patient. The market will always return with a clear opportunity for the patient man. Do not trade just to satisfy an urge. If you lack absolute conviction in your setup, you must hold cash. Conviction is not a feeling. It is the synthesis of price action and volume confirmation. If the rules of the game do not clearly align, your answer is cash. Your capital is safe in cash. It is not generating profits, but more importantly, it is not generating losses. Speculation is not a daily task. It is a carefully selected engagement. You are not obligated to trade every day, every week, or even every month. The man who trades too often is simply paying the market to teach him lessons he already knows. Hold your capital when the market is confusing. Trade only when the signal is pure and your conviction, based on the laws of speculation, is total. Uncertainty is the market's weapon against the impatient. The moment of truth for any position is the retreat. If the price, after breaking out of its pivot point, retreats decisively back below that crucial point of origin, you must exit ruthlessly. This action signals that the primary motive for the breakout, the interest of major players, has failed or reversed. The move was a false dawn. Do not linger. Do not hope for a quick recovery. The stock is telling you that the line of least resistance has not been established in your favor. A decisive retreat past the point of origin means the trade idea is dead. Accept the small loss and move on to the next opportunity. Discipline here saves your entire account. Your capital must be protected from intellectual vanity. The novice panics at every minor reaction. The professional understands the market's rhythm. You must not mistake a temporary pullback for a major reversal in the primary trend. A reaction is normal. It is healthy. It allows the market to gather strength for the next leg up. A true reversal is a completely different phenomenon. A major reversal is not subtle. It is signaled by definite, unmistakable volume and price action. You will see a key support or resistance level break decisively, often accompanied by a massive surge in volume. Until you see that clear, undeniable technical breakdown, assume the primary trend remains intact. Only a confirmed major break of a key level should force you to liquidate your profitable position. Do not be shaken out by minor noise. The biggest mistake is the failure to capture the big move. You must learn to let your profits run. Your opinions, your need for certainty, and your fear of giving back paper gains are the greatest destroyers of long-term wealth. Never allow your emotional need to realize a small gain to stop you from capturing a major swing. The market, not your anxiety, must tell you when to sell. You must hold your profitable position until the price and volume action clearly indicates a major change in the line of least resistance. Wait for the market to give a clear sell signal. Do not sell simply because you feel you have made enough. If the trend is intact, the money is still there for you to collect. Patience with profits is the key to massive speculation gains. A margin call is the ultimate notification of failure. It is a public declaration that you have allowed a losing position to grow beyond your means of control. You must never allow your position to reach this catastrophic point. Liquidate your failing trades before your broker forces the issue. A forced liquidation is the most expensive, most damaging way to exit the market. It destroys confidence and often liquidates the wrong positions at the worst time. Take the initiative. When a trade is clearly going against you and you are approaching your predefined risk limit, take the loss yourself. Preserve the bulk of your capital so you can fight another day. The man who avoids a margin call is the man who respects his capital. Respect your capital more than your pride. The small, quick trades will pay your rent. The massive wealth, the capital that transforms your life, is made only by patiently holding positions through major market swings. You must not be a petty thief in the market, stealing a few points here and there. You must be the man who captures the entire primary market movement. This requires incredible mental fortitude. It requires ignoring the noise of the minor reactions and trusting your initial analysis of the line of least resistance. Once you are correctly aligned with the major trend, your only job is to sit and watch. Do not be intimidated by paper losses during a correction. Big money is not made in a day. It is made by months of patient, disciplined sitting on a correctly selected position. Capture the full move. That is the speculator's mandate. Liquidity is your silent partner. You must trade only in markets and instruments that are highly liquid. This is a crucial element of risk management that novices completely ignore. A highly liquid market allows you to enter and more critically exit large orders precisely near the quoted price. In an illiquid market, a large position can be a trap. If the market turns against you, your attempts to exit will be met with massive slippage. You will give up far more capital than you intended simply because there are no buyers for your stock. This is a failure to respect the mechanics of the market. I have always preferred to operate in the most active securities. Liquidity ensures fair execution. It ensures that when you are proven wrong, you can escape the position at a loss you can manage, not a loss dictated by a lack of volume. Never let your position become a prison. The true definition of a successful trade is not how much paper profit you saw, but how much realized profit you secured. Never, under any circumstances, allow a profitable position that has developed into a substantial gain to revert entirely back into a loss. This is an unforgivable act of trading negligence. It signals a complete lack of respect for the market's gift. The moment a position becomes substantially profitable, your focus shifts from simply managing risk to actively preserving gains. Use trailing stops aggressively. Adjust your stop-loss order upwards to a point that locks in the majority of the profit. This ensures that the market, if it decides to turn, can only take back a small percentage of your gain. Do not be greedy enough to lose a victory. Protect your principal. Protect your profit. A trade is only successful when the cash is in your hand. Look at the true root of every trading failure you have experienced. It is not poor analysis, it is not bad luck. The core problem is always the corrosive combination of impatience and the irrational desire for instantaneous, quick riches. This feverish mentality forces you to overtrade and to accept poor setups. You are chasing the market instead of allowing the market to come to you. The market is a cold, indifferent judge. It is not a machine for instant wealth. Real, sustainable wealth in speculation is a gradual process built on decisive, well-timed engagements. The man who is desperate for quick money takes massive, unnecessary risks. He abandons his discipline. The great speculation fortunes were built with patience. The market is slow, but it is certain for the disciplined man. Slow down your mind. Your system must be based on tested, objective laws of price and volume. If your system provides a clear signal based on these laws, you must act mechanically. There is no room for hesitation. There is no room for hope or doubt in the moment of execution. You cannot stop to think. The time for thinking is during the preparation phase, when you are reviewing the market and defining your rules. The moment the signal flashes, you must be a mechanism of discipline. Act immediately. Execute the plan. Hesitation costs money. It allows the market to move against you, and it allows emotion to creep back into your decision. Mechanical execution of a tested plan is the professional's greatest edge. Trust the law, not your impulse. Failure is inevitable, but failure must be educational. When a trade goes against you, you must review it immediately, not for retribution against the market or yourself, but for cold, objective analysis. You are looking for one of two things. You are looking for a technical error in your chart reading or a psychological weakness that caused a lapse in discipline. Did you miss a volume divergence? Did you enter before the pivotal point was truly confirmed? Or, more likely, did you allow fear to make you sell too early? Did you allow hope to make you average a loss? Use every loss as a tuition payment for market education. Do not repeat the same mistakes. The market's lessons are painful, but they are absolutely necessary for mastery. Learn from your failures or they will bankrupt you. Your entire trading method must be built on the pure, objective observation of price and volume action. These two elements, and only these two, tell the unvarnished truth of the market. You must learn to read the patterns they create. Consolidation, breakout, and confirmation are the universal languages of speculation. Prediction is a fool's game. Never attempt to predict where the market will be. Only react to where the market is. Ignore all outside advice, all media noise, and all private whispers. The answers are on the chart, in the movement of the price and the weight of the volume. Build your own fortress of knowledge. Rely only on what you can see, confirm, and execute against. These are not suggestions. These are the laws of the market. Strict, unwavering adherence to these 25 laws is the necessary discipline. It is the only thing that separates the man who survives the market from the man who masters it to truly thrive. Do the work. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I'm talking about Reminiscences of a Stock Operator. It is not historical, it is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.